Hey everyone, welcome to Stock Market Narratives episode 3. As I explained in the last video, we were going to look at a company where there was max pessimism due to a short-term headwind that kind of kept building momentum against the stock. Short sellers come in, just super negative to where it gets valued near replacement value. So if you had to build everything, if you were able to buy and build everything they own, you'd be paying more than if you just bought the company at the current valuation in the market. So that's what we talk about, if you can get a company around replacement value. And so SeaWorld was privately owned by Blackstone from 2009 to 2013. In 2013, they IPO'd around April 2013 at a valuation of $2.5 billion. It traded up to $39 a share, around $4 billion. And then in December 2013, a propaganda documentary, Blackfish, came out lying about SeaWorld abusing orcas at their Orlando and San Diego parks, and that it led to the killings of trainers and a guest who snuck in the middle of the night. But so that came out in December. It was pretty popular on Netflix, and that following summer, in August, the stock dropped 33% from 27 to 18 on earnings where their revenue growth it actually went down 6%. So they had a reduction in revenue by 6%. And a lot of the blame was the fact that it was from Blackfish. People didn't want to come because of Blackfish. And that there was some element of that to it, but there were other factors that led to that. One of them, they wanted to raise the price of annual passes, and with SeaWorld, the business is really get people in the park, get them to spend money on high margin stuff like food, beverage, merchandise, and experiences. And that's the name of the game. It's just like a movie theater. Get people to spend more money on popcorn than they normally would, drinks, candy. So that's really SeaWorld's business, and they upped the price of their annual pass pretty significantly because they wanted more people to come for the day, and a better balance. And the timing of that decision was poor because they weren't reinvesting in the parks. When they were privately owned, they weren't reinvesting in the parks. So there was nothing new to come see at SeaWorld. And at the same time, Disney was opening Avatar, and Harry Potter came out in 2010, but they expanded and they finished the expansion in 2014. So the competition in Orlando, which was the park that really had the biggest struggle, their Busch Gardens parks were fine. They didn't put anything new, and they had all this competition with Universal and Disney. So at a time that they raised rates, that annual pass, that person might come in 5 to 6 times a year on their annual pass and spend $100 every time they're in there on food and beverage and merchandise and experiences. They weren't getting those people. So that affected their bottom line. And this was sustained until 2016 because there was a lot of factors. It was the competition. It was not reinvesting in the parks. It was so Brazilians like to come to Orlando to the theme parks. It's something that they like to do. Their currency got cut in half against the US dollar. So for them to come here, they would have to, it's like paying double to come here. So they didn't come as much. And that affected SeaWorld's bottom line as well. And then you also had, in 2016, you had 2 events. You had the Pulse Night shooting in June 2016, which was all over the news, and it was right in Orlando. And then you had the Zika virus, which was basically spread by mosquitoes, and that was down in South Florida. So those are 2 things that kind of prevented people from from wanting to travel to Orlando. So this lull in their revenue from 2014 to 2016, some of it was self-inflicted and some of it was headwinds that were short-term, but they couldn't really do anything about. So the max pessimism started coming in around fall 2017. So the stock was, after trading as high as 39, it was between $11 and $16. There was a buyout offer that was declined in October of 2017, and in November the stock was as low as like $11. And then what they've been doing now through this time was they had an activist investor come in, take a pretty good stake in it, and then they just started cutting expenses, getting really lean. And that's what companies do when they're facing headwinds. When things are good, they spend money. They'll sit front row at the Yankee game. When they're not doing well, they're gonna go sit in the upper deck. And so that's what they did. They cut their expenses. Anything that could be cut, they cut. And they also reinvested in the parks. They brought it back some new events that people loved, and they put a new ride in each of the parks. So it gave people something to come back for. There's no reason to go back to SeaWorld if nothing's new, and everything at the competitive parks have something new. So basically it took the first 2 quarters of 2018 to show growing revenue again and growing EBITDA, and the stock rebounded. And by May it was like $22, and by August it was $32. And now keep in mind, this is in a market where the market wasn't that strong. 2018, the market was down. Pretty much every public investment, if you talk about indexes and fixed income and real estate, they were down in 2018. That's when the Fed started talking about raising rates, and so in a kind of weak market, SeaWorld tripled, and that's the purpose of this talk, is basically, if you can buy something cheap enough and it's a good business, ideally you want a great business, but if it's a good enough business to where you can see that this, entertainment is usually a good business over a long period of time because people like to be entertained. So this was something that if you can find these opportunities. The downside, sure, there's still downside. I mean, you can buy something that's cheap and it could still go down 30-40%. But then it's even cheaper. If the thesis is still there, then it's still cheaper, and that becomes an opportunity to average in. But the upside is pretty significant. And you don't even really need that much to go your way to get the upside. You just need that short-term headwind to go away, and all of a sudden the maximum pessimism that's surrounding the business evaporates, and then they start getting optimistic. And as you saw, like SeaWorld, where you can literally go from 11 to 32 in an 11-month period. And with SeaWorld, when it was negative, when there was maximum pessimism, it was like a hurricane was projected to go hit Florida, the stock would sell off 5% because they're going to lose out on a weekend of revenue. And it's like, when you think about the long-term value of a business, one weekend doesn't change the value of the company one bit. And then at the same time, if like a whale got sick, the stock would sell off 3 to 5%. Just things that really have nothing to do with the value of the business. But that's what happens in the stock market. And when there's negativity surrounding a name like that, you have to be able to understand it and kind of weather that storm. Because when it does change, though, it changes pretty quick. And in a market where if a market's doing pretty well and there's something out of favor, well, if the market stops doing well, but that's so out of favor, it's so beaten down, there might be more safety in that company than the ones that are doing well right now. So if you're talking about putting new capital to work, well, you want to buy stuff that's being beaten up, where there's pessimism. You don't necessarily want to buy what everyone else is loving, is price is bidding up, because that's where there's more risk to that. The downside is more. Maybe not the first month, 2 months, but if things change on them, then, or the economy, then those things are going to get hit too. So that's the episode on SeaWorld. If you have any questions about it, let me know. Let me know what you think. There's another one. The next one we'll do on DreamWorks Animation, which was from the 2011 to 2013 time period, and there's some other good ones that we've had in the past too. But yeah, let me know what you think, and God bless.